Hello everyone and welcome to another video. This is Fotis from Fotis Trading Academy, and in this video we are going to discuss price action. We had another video where we discussed the basics, what is support, what is resistance, and what is the trend line. Just a quick recap, we showed you what is the correct way to draw resistance and support, and we also showed you how to draw the trend line, what is the correct way to draw a trend line. So we said that there are many traders that are using these levels as active buy and sell signals. I mean, they use them as triggers based on price action to identify trading opportunities. What we didn't discuss last time is what is exactly the trigger. For example, we mentioned that this is a resistance level, the price goes here and then it moves down. But what could have triggered this move? What could have made us say, okay, let us sell and use a stop potentially above the previous high all the way down? This is a weekly chart. This means that we are looking at a very high interval, and this is important because this removes the noise. Support, resistance, trend lines are far more accurate when we use larger time frames, such as the weekly or the monthly. It is very likely you are a smaller trader, so I think weekly is enough. You don't need to go and use monthly levels. Allow me now to move to a smaller time frame, for example a 4-hour or even a daily. I will use both, so let me just go. I think I hadn't pressed chart auto scroll, so we go to today's price action. So this is the 4-hour. The price stayed and advertised, as we say in auction market theory, above the resistance. It stayed here, but the buyers weren't interested to push this higher. This is why it started moving down, and this is our trigger to sell. But you might say, why? Why this level over here? Why place a stop level to sell in this area? Well, let me show you. Let me start with candlesticks. I wish to say something about candlesticks. Candlesticks are useful if you use them on larger time frames. If you go to a 15-minute chart, for example, and try to look for candlestick patterns, you are wasting your time. It will not be very accurate. You might say, hey, this is a shooting star, or this is a hammer, or look at this wick. For every successful pattern you might show me, I can show you another one that didn't work out. You need to find a tactic, you need to find patterns that offer you an edge, that offer you an advantage. If the chances are 50-50 that it might work or it might not work, then this is not in your favor. So candlestick patterns work on larger time frames. This is why after we have highlighted this area based on the weekly, we move in and we look for the candlestick chart patterns. And what do we see? It is important here to try to understand the relationship between buyers and sellers. Don't try to say, oh, this is that specific pattern that we read somewhere. There are hundreds, tens, I don't know, so many candlestick patterns. The important thing is to understand what is going on between buyers and sellers, because someone might say, hey, there is a doji, there is another doji. Potentially here I also see the price tried to print a new high, but it failed. Sellers took control and we closed below the close of the previous day. So you see what I'm doing here? I'm not trying to place a name on the candlestick. What I'm trying to do at this important level, this is where we begin, the level. At this important level, I'm trying to understand the relationship between buyers and sellers. So I know this is not very good for the buyers. I know that the sellers are trying to take control. And after a certain point, it's not a guaranteed outcome, is it? We place the bet, we place the trade, we use the stop, And this is something out of our control. The only thing we can control is our risk. This is why it is important to always manage your risk very carefully. I don't know, no one knows before the trade, but this is going to move all the way down. Because look what happened in the past. If I go to weekly, someone might say, well, okay, let me use this. I just printed a chart and I'm using paint. So just to make my point. Over here, that was a nice level, a resistance level, but it didn't work out. Someone might say, let me place a rectangle. This was also another resistance level and they were right. But if they sold here, let me mark the level, but if they sold here and they had their stop above and they were waiting, perhaps their stop would be taken out. Maybe, I'm sure we might have some Fibonacci levels here. So the question is, why this level worked right there and this one didn't? Why this level here, another resistance level? Why didn't this one work? So you see, when it comes to trading, there is an element of uncertainty. You don't know after you place the bet what is going to happen, but you can control only one thing, and this is your risk. This is why I'm showing you this. After you highlight the levels that you are doing business, you need to pay attention for the candlestick pattern and to make sense of the relationship between buyers and sellers on a higher level. So allow me to go on a daily. Okay, there you go again. I have to scroll all the way to the beginning. So here we are. So you need to understand the relationship between buyers and sellers. You need to make sure that you are doing business, as I say, at the right level. You need to understand the relationship. And you are also looking for other things. What are those things? Candlestick patterns. This will not give you an edge. So yes, it is nice to recognize a few things, but you will not become a successful, profitable trader if you rely exclusively on candlesticks. The other thing that you should pay attention, that is important, is confluence of support resistance levels. So as I said, let me use some lines over here. This is another horizontal line. Resistance that didn't work out. This is another one over here. But over here we have one that did work. Could we have at these levels some confluence of resistances of other indicators? Let me switch this to black and you will see what I mean. Okay, let me go here. Oh, okay. Let me click defaults. I will remove a 23.6. I don't like it. Okay. So what do I notice here? I notice that right at this level, I have a 61.8. From this high over here, this is on a daily level, but we are looking at data for quite some time. This is from 2021. So we had a big move, huge trend down, and you can see this. It's right in front of you. There's no doubt that this is a very strong downturn. What happens? Over here, yes, we have the 50 level. So this is potentially an area to do business. Okay, what happens? If your stop is getting hit, this is your cost of doing business. But a very crucial point is this one. Why? We have another very important price resistance, and we also have the 61.8 Fibo. So I'm using this confluence, I'm using a confluence of different indicators to make sense of what is happening and try to understand if I have a better edge here or up there. You can also start using other indicators. For example, if I press F11, trend indicators. Indicators can be divided into trending indicators and indicators for sideways markets. Those are the oscillators. So this is a daily chart. If I use a moving average, which is one, if not the most important indicator when it comes to trending markets, So allow me to find now the moving average. There you go. Sorry, I was looking at oscillators. Here's the moving average. Let me use it's the daily. Let me use 200 or even 240. This corresponds to 1 year, to 12 months of information. I click OK, and there you go. Do you see why the price beforehand, and let me press F11 again, why the price bounced at these levels before? 200, 200. And why is this happening? Why it bounced twice in the past, but this time it bounced momentarily and then it moved below and went all the way down to the other side of the range? I'm going to tell you, let me switch back to my favorite drawing. Consider price action. Have you ever seen price moving like this in straight lines? Moves up, moves down, moves up again, moves down in very big trends? No, it doesn't happen this way. Let me delete this. What happens with price action, it moves in increments. It moves up, correct. It moves up, making higher high, higher lows if we have an uptrend. This is how we recognize we have an uptrend, higher highs and higher lows. This is the way the price moves, and the opposite is happening in a downtrend. Lower high, lower low, lower high, lower low, lower high, lower low, lower high. You get the idea, all the way down. Why is this happening? It is important to understand the reason why. The reason this is happening is because of a relationship between buyers and sellers. In order for the buyers to lose their strength in an uptrend, this needs to happen. This is natural. They are testing certain price levels, and there is a certain level where the sellers are going to be interested again. But what must happen? The buyers must get exhausted. That means they must keep buying again and again every time they think it is an opportunity, and they might consider doing business here because it is an opportunity. The price corrects, is closer to support, and they think, hey, this is an opportunity to buy. So this development, this price action needs to become exhausted. The buyers need to become exhausted so they cannot buy anymore. The same thing is happening with sellers in a down move. They keep selling. Okay, when the price moves up, we have a correction, they sell, it goes down again. And this keeps going on until it doesn't. This is the natural way, but the price is moving. The same thing is happening here. Consider what we said. The price moves up, corrects, opportunity, 200. They push up again, comes back down, opportunity. Why? We have a 200. It goes up there, major resistance, and now the sellers have momentum. Why? Because this move, it has been exhausted. If you consider a rubber band, it is as if we are pulling the rubber band to a certain extent, but it cannot go anymore. And not only this, but imagine the energy that is stored at this level. It keeps making higher highs, higher lows until that's it, the buyers are done. They have no more power left. So the price moves down and goes all the way to the other side. So we use a confluence of indicators. We use Fibonacci. You can also use round numbers, 108, 109, 1010, 11, 12. These levels are very important, especially for institutional players. And the other thing I'm going to show you is oscillators in order to give you a better edge. So the best thing to use if you use daily prices is the 200-day moving average or the monthly, the 21. Let me show you with oscillators. If you think that we are in a range and the price is approaching a high, the oscillator will give you a better edge than a moving average. So if I will show you one of my favorite oscillators. I like the stochastic and the Williams percent change, which is right there. And when I choose the period to use, I'm trying to use something that has a relevance with the natural phase. What do I mean by this? I will not use a random number, for example, 12, 14. Why 12 or 14? How many days are in a month? Working days, okay, excluding the weekends, roughly 2021. So I might use this. How many days are in a quarter? Roughly 63 days. So I will use numbers like this. So if I use monthly numbers, this is a daily, 21 days, roughly 1 month. Click OK and press F11 again. What do I wish to do in this case? I wish to do business in an area where the oscillator is telling me that the buyers, in case I wish to sell, are getting exhausted. Do not try to sell when the oscillator is at maximum lows. Why? Consider the example with the rubber band. You have no energy. There is no energy stored to take you further. You want to do business when the oscillator is hitting a high. This will improve your chances of success. So we will be doing business here in this area, and right here, what do we see? Yes, another important level, and it goes all the way down. There are some benefits and disadvantages with indicators. For example, moving averages will work fantastically when the market is trending, no doubt about this, and the oscillators will not work so well if the market is trending. However, if we are inside a ranging market, then you will get very good signals with the oscillators, but not so good signals with the moving average. So this is why I'm saying you must be using your brain and do not try to have 100% mechanical rules, because you are human, you are not a robot. So you need to understand the relationship between buyers and sellers when you use these indicators. Yes, you can do business at support and resistance. You can use a moving average and an oscillator, but try to consider what this means from the perspective of the whole market, of the auction. So this is what I wanted to say in this video. We started discussing price action, and we moved from support and resistance to how to use price action together with indicators such as the moving averages or the oscillators, and do business in areas of confluence. In the next video, I'm going to show you how to improve your edge even more and have even more accurate signals.